Hello and welcome to Mukoya Finance. My name is Sarah Dean and I'll be your tutor in this class. In this tutorial, I'll talk about reserve requirements for banks that are licensed and supervised by the Central Bank of Nigeria. Banks cannot lend out all the deposits they collect from customers, or they wouldn't have enough funds to pay back depositors upon demand. Central Bank specifies a minimum fraction of the total deposits of customers which banks have to hold as reserves, either in cash or as deposits with the central bank. This is called the cash reserve ratio or CRR. The aim here is to ensure that banks do not run out of cash to meet the payment demand of their depositors. Cash reserve ratio is also used for controlling money supply in an economy by reducing the amount that can be given out as loans. For example, in Nigeria currently, when you deposit your money with your bank, the bank must take 32.5% of the money deposited to the Central Bank of Nigeria for safekeeping as cash reserve ratio. The rest of the money can be used by your bank to give out loans or conduct other permissible businesses. This is an example of how the cash reserve ratio works using 20% reserve requirement. Let's assume you deposit 1,000 naira in your bank. Your bank keeps 200 naira of it to meet its reserve requirement but lends 800 naira to Mrs. BC. She uses the money to buy a car. The car dealer deposits the 800 naira in their account at their bank. The bank keeps 160 naira of it as reserve but lends out the remaining 640 naira. When that money is lent out, it becomes a deposit in a third institution and the cycle continues. Therefore, in this example, your original 1,000 naira becomes 2,440 naira of deposits in three different institutions. This phenomenon is called the multiplier effect. The size of the multiplier depends on the amount of money banks must keep or reserve. The central bank can contract or expand the money supply by raising or lowering banks' reserve requirements. Banks themselves can contract the money supply by increasing their own reserves to guard against loan losses or to meet sudden cash demands. A sharp increase in bank reserves for any reason can create a credit crunch by reducing the amount of money a bank has to lend. And this brings us to the end of this video segment. If you have learned anything new today, please drop a comment, like, and subscribe to my channel in your quest towards understanding banking services in Nigeria. See you in the next video.